In the world of trading, there is a well-known rule: the market is always right. This simple phrase carries a deep philosophy within it. It means that it is pointless to argue with market reality. The price is what it is, and our opinions do not affect it. In this video, we will analyze why it is important to accept this truth, how ego and a refusal to admit mistakes hinder a trader, and what experienced investors teach about humility and objectivity. The tone of our conversation is mentoring and motivating. We will urge you to be honest with yourself and respect the reality of the market. By understanding why the market is always right, you will take a step toward a more mature approach, which means increasing your chances of survival and success in trading. It is dangerous to argue with the market. Let's start with a typical situation. Suppose you bought a certain asset at a price of $100, confident that it should rise. But the market went against you. The price drops to $95, then to $90. On the screen is a downward chart. The loss is growing, and instead of exiting, you look for an excuse. It's the market that's behaving incorrectly, you think. Just a little more, and it will come to its senses. Sound familiar? Many of us have gone through this. The ego doesn't want to admit a mistake, and the trader continues to sit in a losing position, hoping for a miracle instead of cutting the loss, for example, with a stop order. A beginner stubbornly holds the trade and even averages the position, convincing themselves that the market will soon turn around. Unfortunately, the opposite often happens. The losses only continue to mount. So why does this happen? The reason lies in our emotions and beliefs. The desire to be right at any cost forces us to deny the facts. A trader can spend hours coming up with explanations for why the market is wrong or failed to value the news instead of soberly seeing that the trend is going against them. Ego and pride do their work. Admitting a miscalculation is unpleasant as it hits one's self-esteem. Instead of humility, hope arrives. Right now the market is unfair, but soon everything will return to normal, and my brilliant idea will prevail. Unfortunately, hope is a dangerous advisor in trading. As they say, there is no room for dreams in the market. The market goes its own way, regardless of our desires. It doesn't care if you consider the losses to be unfair. If you are in the red, it means a mistake was made somewhere, in analysis, in timing, or in risk management. Experienced traders warn you cannot trade with the belief that the market is wrong. In other words, do not try to impose your opinion on the market. If the facts say your position is losing, then it is you who made a mistake in assessing the situation, not the market. As the famous speculator Jesse Livermore aptly noted, the market is never wrong, opinions are. And trader Marty Schwartz, a Wall Street champion, taught, the market is always right, and you are not. Your job is not to prove the market is wrong, but to quickly admit your mistake and preserve capital. Simply put, stop arguing with the chart. It is more important than your opinion. The market owes no one anything. It's important to learn one thing: the market doesn't owe you anything. It is not obliged to return lost money or behave according to your expectations. The market is neutral. It is neither good nor evil. It doesn't care whether you have a position or not. It is a mistake to expect justice from it. If you lost on a trade, do not blame external circumstances. Accept it as an experience. Stop hoping that the market will magically give back what you squandered. Such an approach will only prolong the agony of losses. Instead, develop objectivity, the ability to see the situation as it is, without illusions. Is the price falling? That means something is going differently than you assumed. Acknowledge this fact and take action. Humility before market reality does not make you weak at all. On the contrary, it is a sign of sanity. Successful traders say, it is better to part with your opinion than with your money. After all, making a mistake is not scary. It is much worse to persist in an error. Remember, exiting a losing trade on time is how you fix a mistake, not a defeat. Every unit of capital saved today gives you a chance to earn more tomorrow. To develop objectivity, it is useful to create a set of rules and stay disciplined. For example, decide in advance. If the market goes against my plan by more than X%, I will exit without regret. Follow this rule automatically, without letting your emotions paralyze you. As experts advise, hold a position only as long as the market behaves according to your forecast. If price movement clearly goes against expectations, the position must be closed. Simply put, trade what you see, not what you want to see. If the chart breaks your original plan, step back. Taking a small loss today is better than waiting and doubling your losses tomorrow. Here are a few principles to help you stay objective and humble before the market. First, always set a stop loss and stick to it. A protective stop is your insurance exit. It exists specifically for the case when the market goes against you. By setting a stop order in advance, you admit the possibility of error and limit its cost. This is not weakness, but wisdom. A stop order is the practical embodiment of the rule, protect your capital. Second, do not average down your losses out of stubbornness. Adding money to a failing trend is like trying to put out a fire with gasoline. Instead of averaging, admit the mistake and save your remaining resources for new opportunities. You can always open new trades, but recovering lost capital is much harder. Third, keep your emotions under control. Fear, greed, hope, these feelings can cloud reality. The desire to take revenge on the market after a loss is especially dangerous. In such a state, it is easy to break all the rules and increase the loss even more. Take a break, cool down, and remember that trading is not a fight with the market, but a fight with yourself. The main battle happens within, with your own ego and emotions. Fourth, learn from every loss. Instead of shouting, "The market was wrong," ask yourself, "Where was I wrong?" Maybe the signal was false or the risk was too high. Analyzing the situation without self-blame helps you learn lessons. Every closed loss is the price of an education. Record such cases so that you do not repeat the same steps in the future. Humility and the development of maturity. Accepting the principle that the market is always right does not happen overnight. Often a trader reaches it through a series of painful mistakes and lessons in humility, but it is through these lessons that maturity comes. A mature investor does not take the market personally. He does not try to prove he is right with every tick. Instead, he flexibly adapts to changing circumstances. If conditions change, the plan of action changes as well. Such flexibility is an indicator of developed objectivity. Humility before the market does not mean passivity or fatalism. It means respecting reality, following the trend when it is obvious, and not demanding from the market what is not there. As one expert figuratively put it, going against a strong trend is like standing in the way of a steamroller on a one-way street. You may be absolutely sure the roller is headed the wrong way, but in the end, you risk being crushed if you stubbornly refuse to yield. By showing humility, you do not get under the steamroller. You either go around it or wait for it to pass. In trading, this means not going against the dominant trend without good reason. If the market is plunging, do not try to be a hero by catching the bottom with everything you have. Be patient, the situation will clear up, and you will still have a chance to enter when the risk is lower. A trader's maturity is also shown when they let go of the feeling of knowing it all. You cannot control the market, but you can control your reaction to it. Admitting you're not all-powerful paradoxically makes trading easier. The pressure to prove you're right disappears. Instead, you simply work with what is there. In the end, excessive stress also goes away. You're no longer angry at the market or trying to prove anything to it. You accept uncertainty as an inherent part of the game. This approach brings psychological relief and financial benefit. When there's no attachment to wanting to be right, decisions are easier and faster. Seeing an exit signal, a mature trader exits without fear or regret because they know there's nothing terrible about a mistake. It's terrible to turn a mistake into a catastrophe by continuing to deny it. Humility allows you to cut losses without hesitation, saving energy for the next trade, and preserved capital is the main resource that gives you a long-term advantage. Let's summarize. The market is always right, and this isn't a defeatist phrase, but a sound principle that frees a trader from illusions. The market is not obliged to meet your expectations. If you've accepted this, it'll be easier to act objectively, admit mistakes, adjust plans, and move on. Applying humility and discipline, you stop seeing a miscalculation as a tragedy for your self-esteem. Instead, you focus on the main thing, preserving capital and finding new opportunities. The principle that the market is always right has been tested by generations of traders. Accepting it is a sign of maturity and a guarantee of survival in trading. A mature trader doesn't fight the market or try to outplay reality. He respects the market and learns from it. Every trade is a dialogue with the market, and wisdom lies in listening to what the market says, not your ego. May these lessons of humility and objectivity help you become more flexible, cautious, and successful. Remember, the market is always right, and our task is to recognize it in time and act accordingly. By accepting reality without argument, you'll make trading a collaboration with the market, not a struggle. And by collaborating with the market, it's easier to achieve your financial goals. Good luck and discipline in your trading.